All right, good morning, everyone. This is Tom Vukovic with Insurance Network America. I want to thank you all for joining us today. It is about 1 minute before the hour. I'm going to give it a couple more minutes to allow a number of other people to get on the call. So if you just hold tight for a couple of minutes, we'll get underway. Thank you. Okay, I've got about 3 minutes after the hour, so we will get underway. I want to welcome everyone for joining us today, and on our call, A Tale of Two Incomes, Predictable and Potential Income. My name is Tom Vukovic. I head up the Financial Products Division with Insurance Network America. As always, we are committed to providing you with great ideas and tools to continue to build your business. Today we have a terrific turnout, and as I look over our list of attendees, I see a lot of familiar names that are a big part of our INA family already. I want to sincerely thank you not only for your commitment to our partnership, but also for your continued business. I'm also really excited to see many new names with us today. I want to thank you for joining us as well. I want to strongly encourage you to consider contracting with us at Insurance Network America. We have numerous contracts and solutions available in all product lines, and we have the right people to help you. We do this by putting your clients and your business first. If you're ready to feel special by working with a marketing organization that truly cares and treats you with the level of service and support you deserve, you need to call us. If you find today's call helpful and you think of clients that this could be useful for, please call us. Again, we have the right solutions, the right contracts, the right people to help you. So write down this number, 456-7999. That is us directly. And during today's call, if you have questions, please submit them on the GoToWebinar. We will address them at the end of the presentation. And at this point, I would like to introduce an outstanding partner to us, always providing terrific ideas and concepts. Thank you for joining us today, the very talented Casey Lane, who is the Vice President at North American. So at this point, I will turn it over to you, Casey, and take it away.
Well, thank you very much, Tom. Appreciate that introduction. A good day, everyone. As Tom mentioned, my name is Casey Lane, and on behalf of myself and all the other employee owners here at the North American Annuity Division in West Des Moines, Iowa, thank you for taking time out of your busy schedules and away from your clients and prospects to join us here today. You know, obviously, as independent agents that work on commissions, you folks aren't making any money unless you're out in front of clients and prospects. So for you to take 45 minutes, an hour or so out of your busy schedule and away from those folks, again, is very much appreciated. As is anybody here on the call today that has written any North American annuities and or life insurance business, thank you for the opportunity to earn that business. Tom, Insurance Network America, thank you guys for giving me an opportunity to be here on the call today. More importantly, thank you guys for being a true partner with North American. We have a lot to get through today, so we're going to go ahead and jump on in. And obviously, Tom and I and Insurance Network America, we want you folks to get the most out of your time here with us today. So the only piece of homework that I have for you, I know it's early for some of you here today, but the only piece of homework I have for you is as I go through the presentation, if a client's name or a prospect's face pops into your head for whatever reason, whatever it is I'm talking about at that time, I'm going to encourage you to write down that individual's name right then and there. Because, folks, I will guarantee if you're anything like me and you try to wait till the end of the presentation, you're going to forget who it was you wanted to talk to and what it was you wanted to talk to them about. So my goal here for you today at the end of our time is for you to have 2, 3, 4 or more names of clients or prospects that you can pick up the phone when you're done or when you're back at the office or whatever, and you can call and you can talk to about a tale of two incomes, predictable and potential maximum lifetime income. Now, I know most of you here on the call, you're on this call because you write annuity business in some way, shape, or form, or lifetime income benefits. And if you've been paying any attention to the environment recently, you know that effective 1/1 of this year, a number of states, including Iowa, where North American is officially domiciled, adopted some new mortality tables. So the good news is, and I'm sure you're all happy about this, but hey, we're living longer, folks. That's great news. I think it came out to just under 2 years longevity, increased longevity with the new mortality tables. So again, the good news is we are living longer. The bad news is, unfortunately, us insurance companies who guarantee these lifetime payouts, these lifetime incomes, because of this increased longevity, we now have to set aside more in reserves to guarantee the lifetime incomes. So bottom line is, and I'm sure, again, you've seen some trends and things the last 12 to 18 months or so, a number of companies, including North American, had to make some changes to their income riders, again, to make up for or to continue to pay out guaranteed lifetime incomes. Now, I think what you'll find a lot of companies did, again, now this has happened over the last 12 to 18 months, what a lot of companies just did when they made their changes to adjust for the new mortality tables is, one, they either decreased the roll-up or the interest that's credited to the client's income value. Some other companies decreased the client's payout percentages that are applied when they start taking lifetime income. And I think I saw a few companies that did a little combination of both of those things. Now, again, we did have to make some minor, I hate to use the word negative changes, but I think the one thing we did that nobody else did, at least that I'm aware of, at least that is a major contender in the guaranteed income market space, where a lot of companies just made those negative changes, folks, we actually took the opportunity to utilize the feedback that we've been getting from you out in the field, from our partner distributors like Insurance Network America, their staffs. We've been getting feedback over the years about, what is it we can do as a company to enhance, to make our income riders better. So at the time, same time that we made a few negative adjustments to our income rider, folks, we took the opportunity to also make some very significant and very nice enhancements to our old income rider. And again, I don't think any other company took the opportunity to also enhance their income rider. So, bottom line is, it's not all doom and gloom, folks. Yes, again, we're living longer. Carriers had to make changes to these things to adjust for the mortality tables, but it's not all negative. And the one thing I want you to keep in mind as I go through the presentation, when it pertains, or as it pertains to these fully guaranteed lifetime income riders, it doesn't matter what the roll-up rate is or what the interest that's credited to the income value is. It doesn't matter who's got the highest lifetime payout percentage. It doesn't matter if a bonus is credited or not credited to the client's income value. The bottom line is, when you are running illustrations and you're checking to see who's the best here, you're looking for a carrier that's got maybe not always the highest guaranteed lifetime income, but you're looking for a company that does offer very strong guaranteed lifetime income. It's the bottom line number. It doesn't matter how we get to it. You could have a 20% compounding roll-up, but if your payout percentage is 1%, you know what? What good's a 20% compounding roll-up do? So again, just keep in mind, it's the bottom line income that the client is going to receive. I also want you to keep in mind is, even though we had to make a few negative adjustments, you're going to actually find that there are a number of scenarios and situations where a client is actually getting more guaranteed lifetime income now with the new Income Pay Plus rider than they were with our old income rider. So again, keep that in mind. Two things on the agenda, two things of probably 20 minutes of each of these, but first we're going to talk about the new Income Pay Plus rider and what changed there, and then we're going to focus on the Income Choice Index Annuity. So let's jump in and let's start with the Income Pay Plus rider. And folks, I know you're having more and more conversations today with clients about guaranteed lifetime income. I mean, these things have been the hot topic in our industry for 7-8 years now. And I'm sure a lot of your conversations revolve around, or you get some similar questions from your clients and prospects. And again, probably the biggest one is, what if I outlive my retirement savings, or I don't want to outlive my retirement income? How can you help, Mr. Agent? The next one, this is big, inflation. Is my income going to keep pace with inflation? Will I still have the purchasing power of my income today? Will I still have that 5, 10, 30 years from now? And again, folks, we're not just planning for 5 years or 10 years of retirement. I mean, clients, as we know, are living longer today. We have to plan for 20, 30 years plus of retirement. Can that client's dollars, can they keep pace with inflation and keep their purchasing power? What about nursing home? Man, I don't know what the statistic is, but an awful lot of us are going to spend some of our lifetime in a qualified care facility. Do you have the answers? Do you have benefits that can provide additional benefits for clients if they happen to be confined to nursing home or long-term care? And then the last one, we term this flexibility. I think that's a good word, because as you know, a lot of clients, they change their minds during retirement years. They run into things pop up that they weren't expecting. So bottom line is, will a client have control of their retirement savings or income to adapt with maybe a changing lifestyle, maybe unforeseen expenses or circumstances? So the nice thing about the new Income Pay Plus rider, folks, is it answers, or it provides a solution for all 4 of those questions that you see on the screen. And we're going to cover each of those here in just a minute. But let's take a look just at a very high level what the new Income Pay Plus rider looks like. It is available on 2 of our indexed annuities, the Charter Plus Index Annuity and our Retire Choice product. Those 2 products are the 2 products that you can add the Income Pay Plus rider to. You have to be at least 40 at the time of issue, and you do have to add the rider at the time of issue. You can't say 3 years from now that you've changed your mind and you want the income rider now. It is revocable though, so again, if a client 5, 8, 10 years from now changes their mind and they don't plan on using this for lifetime income, they can always ask to have that rider removed, and we will no longer charge any fees for that. So, you know, the big question we get, I'm sure Insurance Network America gets it too, the biggest question I still hear our sales desk answer is, you know, what's the roll-up amount, or how much are you going to credit each year to my client's income value? And everybody's got a different number out there. I mean, there's a whole slew of different numbers. Every carrier is a little different. The Income Pay Plus rider has a 6.25% compounding roll-up guaranteed for 10 years. And it will only go for 10 years. It will not go any longer. Yeah, if also, by the way, a client happens to start taking income, let's say in the 5th year, once they elect to start taking that income, that 6.25% compounding roll-up stops. They're not going to get that again once they've triggered that lifetime income. Now, I don't know if any of you remember the old Income Pay rider, but we had a 6.75% compounding roll-up for 10 years. So keep that in mind. But again, remember what I mentioned. It's not all about the roll-ups, the payouts. It's what's the bottom line income. And that cost is $1.05%, 105 basis points per year. Now that cost is based on the income value and is deducted annually from the accumulation value. So that's kind of the high-level basics of the Income Pay Plus rider. So what about the enhancements? What is it that we did? Again, I mentioned we took the opportunity to actually make some positive changes. So here's some of the changes. Number one, we offer now an increasing payout option for the client. They can choose either a level or increasing payout. And again, we're going to cover each of these here in just a minute. Folks, I mentioned a lot of companies maybe reduce their lifetime payout percentages with the, you know, to adjust for the new mortality tables. We actually took the opportunity and we increased our payout percentages, our lifetime payout percentages. I'll show you a screenshot on that here in a minute. We also added to kind of cover that flexibility question, or what if things change down the road, or what if an emergency pops up. We added in lifetime payment amount reserve account, kind of a bank account. We also made this rider completely penalty-free withdrawal friendly, meaning if you take a penalty-free withdrawal at any point in time during that first 10-year period, you still will receive that 6.25% compounding roll-up. Before the old rider, it was RMD friendly, but it wasn't penalty-free withdrawal friendly. So again, another nice enhancement. And the last positive change we made, the old rider, you could add on an optional nursing home or income doubler, if you will. It is built into the rider now. There's no additional charges for it. It's just a part of the rider. So again, some very nice enhancements. Let's take a little closer look at each of these here. So that first question we talked about was the inflation question. And you remember, can my income keep its purchasing power 5, 10, 20 years from now? So I mentioned we added an increasing payout option available as well. Now, just like choosing either a single or a joint lifetime payout, folks, you don't make the election. You don't choose the level or the increasing until you're ready to start taking income. We're not going to make you choose this at the day you purchase the rider. When you're ready to start taking income is when you choose either a single payout or a joint, or a level or an increasing. Now, once you've elected it, you can't change it. You can't go back and forth. But again, you don't make that election until you're ready to start taking income. So, quick example here. This shows a client that was 50 at the time of purchase, and they are starting now to take income at age 55. So they're 5 years into the contract, and we're assuming based on whatever their income value was and their payout percentage, if they chose a level payout, they will get $11,374 guaranteed for the rest of their life, no questions asked. Which again, nice number, very competitive number if you compare it to the competition. Is it going to be enough 10, 20, 30 years down the road? Will that $11,000 still be able to have the same purchasing power? Odds are it's probably not going to. So if you've got clients that are concerned about inflation, there is an option, an increasing payout option. Yes, you do start at a lower level. The payout percentages are actually 1% less for the increasing option. And as of today, if a client were to start taking income, or they have the opportunity to elect taking income today, they would receive a guaranteed 2% increase to that income every single year for the rest of their life. Now, just a couple of things here about the increasing option. That current 2%, what determines that? It's not an external index. It's not a consumer price index. It is more interest rate driven than it is anything else. So what that means is 5 years from now, if a client's ready to start taking income, when they elect the increasing, or before they elect the increasing, they know exactly what that annual increase will be. Now, it could be 5 years from now, it could be 3%, it could be 7%, it could be 0.5%. I can't tell you what it's going to be 5 years from now or 2 years from now. Do know this, there is a contractual minimum. It's 25 basis points, so there is some increase that will take effect no matter what, and there is no maximum. So again, it's more interest rate driven than it is anything else, and the client knows prior to selecting the increasing option what that annual increase will be. Again, today, it's 2%. A year from now, it could be 3, it could be 5, it could be 25 basis points. I will say this, and everybody always mentions the contractual minimums or the contractual maximum stuff. If the increasing payout option drops to 25, I mean, think about it, we're given 2% increases today, and we're still in an historically low interest rate environment. If we have to drop that to 25 basis points, folks, we got a lot worse things to worry about than increasing a client's annual income by 25 basis points. But the good news is, Mrs. Client, that will go for the rest of your life. Now on the screen here, we show it going through age 80. If that client lived to 124 years old, they're going to get a 2% increase every single year for the rest of their life. Even if their account value drops to 0, even if their income value has been depleted, that income is guaranteed to increase 2% for the rest of their life. Not to age 85, not to when the income value or account value is 0, for the rest of their life. That's pretty powerful. So, I always get the question, well, what do I choose, Casey? Do I take level or increasing? Well, I mean, yes, it is going to take some time for that increasing option to catch up to what the level is paying. So the question is, Mrs. Retiree, are you in good health? I mean, or if you're only expected to live another 10 years or so, by all means, I would choose the level increasing option. But if you've got longevity in your family and you plan on living to 120, by all means, there's no reason I would not choose the increasing payout option. So again, the choice is yours, the choice is your client's. Adjust for taking into consideration inflation and purchasing power with the increasing payout option. Second enhancement, again, I mentioned this, folks, we actually increased our payout percentages, number one. You can see on the screen here, we actually increased our payout percentages 20 basis points from what they were before. And that doesn't sound like a lot, but I tell you what, it has a pretty big impact. And the other thing we did, the old rider, we had our payout percentages, they were bracketed every 5 years. That's when you saw the adjustment up. Starting at age 60, with the new Income Pay Plus rider, those payout percentages increased 10 basis points each year up through the client's age 80. So by increasing our payout percentages, again, I mentioned earlier, there's a number of situations where the client actually is going to get more guaranteed lifetime income than with this current rider than with the old one. And that has a lot to do with this, what you see here on the screen, actually increasing those payout percentages. I can't think of a company that made that adjustment recently to adjust for the new mortality tables. So higher payout percentages. Okay, what about that flexibility question? The question of, will I have control of my retirement income in order to, adapt or adjust to any changes that may take place, or maybe an unforeseen circumstance that might pop up down the road? The thing we have to remember about this rider, folks, is it is a guaranteed lifetime withdrawal benefit rider. We're not annuitizing the contract. Again, this is a withdrawal benefit. You can start and stop taking that income anytime you want. You don't have to take the full amount of your guaranteed lifetime income. You can take less than that. So there's a lot of flexibilities just in and of itself as being a withdrawal benefit rider. But on top of that, we understand that your client's retirement needs may change. Perhaps they want to prepare for, again, an unexpected expense, plan a dream vacation, maybe pay for a grandchild's college education, or just simply have some flexibility later in life with their guaranteed lifetime income amount. And the lifetime payment amount reserve, that feature that we built into this thing, provides them the flexibility to really customize their lifetime income to fit their own personal goals. So here's how it works. In any year after you've triggered your lifetime income, you can choose to take less than the full lifetime payment amount. Again, remember, this is a withdrawal benefit. We're not annuitizing. You don't have to take that exact payment. You can take less than that. At the end of each contract year, the portion of that lifetime payment amount that is not taken is placed into this LPA reserve, this bank account, if you will. That reserve value is then available to be taken as a lump sum at any time, or it can be just periodically withdrawn down on until the reserve has been depleted. Okay, so a couple of examples here for you I want to go through just to show you exactly how this works. In this example, we have Ed, who in the 5th year starts taking income, and based on his age, he can take, it's about $11,000, we'll just say $11,000 to make it easy. So he could take this solid green line, $11,000 for the rest of his life guaranteed. But instead, he chooses, he doesn't need that full amount right away. For whatever reason, he decides to take, let's just say, half of that, $5,500. He takes $5,500 for a couple of years, okay, and banks that other $5,500. So here in year 7, if he needs it or wants it, he can now take up to basically $15,000 a year for 3 or so years, again, until that reserve has been depleted, and then it will just simply fall back to the original lifetime payment amount. So again, taking periodically, put that reserve in there and take it periodically, or he can do what we show here in scenario 3, the purple one. For 3 years, again, he doesn't take the full lifetime payment amount. Instead, he takes, let's just say, $2,500 a year for 3 years, and each year, again, we're banking that extra $8,500. So come year 8 of the contract, he's got a granddaughter or grandchild that's ready to go to college, and he says, you know what, let me foot the bill for you for the first year. And I'll tell you what, folks, 8 years from now, $35,000 or $38,000, that might not even get you 1 year at a public in-state college. As you know, their costs are rising for colleges, but Ed takes advantage of that, takes that lump sum, and he just pays for that granddaughter's college education that first year. And that reverts them back down to his original $11,000. So again, just a nice opportunity to provide the flexibility for unforeseen circumstances, or again, to even just plan for things like college education, a trip around the world, whatever it might be. And I do get the question a lot, Casey, does that, the LPA reserve, does that earn any interest? So here's what happens. We have basically 3 accounts that we have values in. You have your accumulation value, you have your income value, and then we also have this LPA reserve value. So what happens is, in this example, he can take $11,000. He instead chooses to take $5,500. So first of all, that $5,500 he doesn't take still stays in the account value, okay, and earns interest in the account value, and $5,500 is placed in his reserve. If he takes $5,500 again next year, again, that extra $5,500 stays in the account, earns interest. $5,500 is placed in the reserve. So now after 2 years, he has $11,000 in the reserve account. So the reserve account itself does not earn interest, but again, that money is also staying in the account value and earning interest over there. So again, reserve account is just the portion that is not taken. It does not include interest. But again, it provides flexibility. Last feature here of the Income Pay Plus rider, nothing new here other than, again, this multiplier, this income doubler is built into the rider now. You don't pay any additional costs. But you know, folks, as well as I do, and you're probably having this question pop up a lot in your conversations with clients, and that is, well, what if I happen to go into a nursing home or long-term care facility during retirement? How can this product, how can this rider benefit me, Mr. or Mrs. Agent? Well, the good news is Income Pay Plus rider will provide in the client's most time of need basically a double of their guaranteed lifetime income amount. So you can see here, example, client was taking income, $11,000, $11,300 a year. After a couple of years of taking income, lo and behold, they happen to be confined to a nursing home. And this is a confinement feature, folks. So the client has to meet a 90 consecutive day confinement to a qualified care facility in order for this to take effect. So once it does, you can see that their income is guaranteed to double for a period of 5 policy years. Now that period doesn't have to be consecutive, as you see here on the screen. It doesn't have to be 5 years in a row, all right? You can go in for 2 years, maybe you get out, 3 years later, maybe a hip is broken, you go back in. So it's 5 years for the life of the policy. And if you have chosen the joint income feature, it is based on either you or your spouse's confinement. So even if we have a qualified account where we have a single annuitant and owner, you can choose a joint income payout option as long as your spouse is the sole primary beneficiary. And again, if either of you in that situation are confined, the income doubler takes effect. And by the way, if it is a joint income situation, it is still a true income doubler. We will still double your income. Once you've reached the 5 years, it will simply revert back to your original lifetime payment amount. And you know, I don't know what the average length of stay is in a qualified care facility, but I don't think it is over 5 years. I think it's actually, matter of fact, is actually shorter than that. So again, income doubler in the time your client needs money the most. So high-level overview here, folks. We package this all together with the nice enhancements, with the 6.25% guaranteed compounding roll-up, and I'm sure some of you are thinking, well, yeah, Casey, I'm selling a 8% simpler, I got a 6.5% compounding roll-up with ABC company, so that's got to be better, right? Again, folks, it doesn't matter how you get to that final end number. What's that client's guaranteed lifetime income? That is the bottom line. What's the income amount? Doesn't matter how we get to it. So what we've done is we actually have done a great job of really, you know, stacking ourselves up against the competition. How do we compare to the competition? Because I don't know how many times I get the question, Casey, I'm selling ABC companies. How do you compare on a 60-year-old that defers for 8 years and takes a joint income option? How are you going to look? You know, without running an illustration, I really can't tell you exactly. But as a high-level overview, take a look at this, folks. This is comparing our Income Pay Plus rider on a 10-year contract, our Charter Plus 10 index annuity, showing issue ages basically 50 to 75, taking income or deferring income for 1 to 10 years, and then triggering income in all those scenarios. Now, the total number of scenarios I think is 286 or something like that. But when you compare us to the #2 selling index annuity contract from third quarter of last year, actually I think overall last year it was the #2 selling index annuity contract. When you look at us compared to female payouts and joint payouts in all those scenarios, I think we stack up pretty well. The female scenarios, we beat them in those scenarios 100% of the time. The joint payouts, we beat them in 99% of the time. And I can tell you on the male payouts, we are less in most situations, but that difference is very minimal. I believe the maximum difference in all those scenarios is about a 3% difference in payout. And I can tell you, with the other features that we have available on this rider, I don't know why you would even give a client a little extra 3% income when you've got actually better ratings, better financial strength, and also some nice enhancements that we made. So bottom line here, folks, let me get to the point, is no one rider, no one company is going to be the best in every single scenario. Do me a favor, give us an opportunity to show you where we do stack up on the fully guaranteed predictable income side. Call Insurance Network America, let them run an illustration for you. I think you're going to find where you're going to be competitive in most situations when it comes to fully guaranteed predictable lifetime income. So that was the predictable side, folks. That was the fully guaranteed lifetime income side. Now we're going to switch gears. We're going to flip our hats here. Now we're going to talk about the potential maximum income side of things, okay? By that, we're going to talk about the income choice index annuity product. Now, again, like the income pay rider, we also had to make some tweaks here to the income choice product as well at the beginning or late last year. But at the same time, again, we took the opportunity to make some nice positive enhancements to the income choice product. Now, I do want you to notice here, this product, which again, it's a product, okay? It was designed to provide both predictable and potential maximum income. And you'll see where both of those come into play here in just a little bit. So because this is a product and it's not a rider that you add on to a product, all the income features are built in, okay, built into the income choice product. And for that reason, your client, number one, very important, does not pay any fees or charges for the income features. Let me repeat that. This is an income product designed to provide predictable and potential maximum income, and there's no annual charges or fees that are reducing your client's accumulation value, like there was on the Income Pay Plus. Remember, 1.05%. So again, keep that in mind as I go through the rest of this. No charges or fees reducing your client's account value. So, who is a prospect for this product? Who should you as an agent be targeting? And this is where I want you to be thinking in the back of your mind about your database of clients and prospects. And who comes to mind? Who comes to mind that doesn't need the highest level of guaranteed income? Okay, this product is not designed to provide the highest guaranteed lifetime income in the industry. So if you're looking for that, if a client needs that, that's where you talk about the Income Pay Plus rider. That's designed to provide the highest guaranteed lifetime income. So number one, this is the income choice is not for a client that needs the most guaranteed lifetime income. Number two, I know you're all familiar with Tom Hegna. INA had him out last year at their summit. I believe this year as well. Looking forward to that. Tom's a great guy. He's an ambassador for our business, our products, income type products specifically. Remember his Paychecks and Playchecks book, if you will? Folks, this income choice is exactly a paycheck and playcheck product. Okay, so paychecks are your what we need to cover our bills, those things that hit the mailbox every single month, right? We've got that, and we also have the country club membership, right? We've got the yacht slip down at the marina. We've got the bridge club that we're gambling at every week. Whatever the situation is, clients have playchecks as well. This product you'll find can cover both paychecks and playchecks. So we'll talk more about that. We already talked about the no cost, no fees. I'm sure you all have clients that hate paying fees, charges. They don't like it. If you have a client that's in that situation, Income Choice 10 is a great product. Also, a client that has more than 10 years until they're ready to start taking income. I say that because Income Pay Plus, again, only goes for 10 years on that guarantee roll-up. The Income Choice will go for up to 20 years. So if you've got a client that has more than 10 years, you might want to look at the Income Choice 10. I always get this one too. A client sitting on the fence. They don't know, I may use this for income. I might not use it for income. I don't really know at this point in time, but I'd like to keep my options open. Because your client's not paying any charges or fees, folks, this is a great also accumulation product. And I say that, I'm not going to get into details about the crediting methods and indices that are available, but there are 6 different strategies in this product where we don't apply a traditional cap, or it's a quote-unquote uncapped crediting strategies. So the upside potential in this product is wonderful, and when you're not paying any fees, you're not dragging down those returns or those interest credits. So even though this is designed for income, it's also a good product for a client that might not end up using it for income because there's no charges coming out, reducing their accumulation value, and they've got some nice uncapped crediting strategies for potential growth. And then lastly, folks, we talk about it all the time with our clients. You plan for guaranteed lifetime income for them. Are you doing it for yourself? Do you yourself have a personal pension plan? Because I know as an independent producer, you don't have an employee defined benefit plan, right? Not a lot of employees even have those today. So I say personal pension plan because this is a great trail commission option product. And without knowing commission levels, I can tell you at a street level, you can get a 1% trail commission starting in the 13th month on this product. And what are trails based off of? They're based off of your accumulation value. And if there's no fees or charges coming out of your account value, man, this can be a real nice pension plan. So think about that for yourself as an agent. So here's the enhancements we made. 2 enhancements. Number 1, and we'll cover each of these in a minute. We used to have a 100% stacking roll-up, participating roll-up. We increased that to 150% stacking roll-up. And we also added an increasing participating lifetime payment amount option. So again, cover both of those here in just a minute. I want to make sure we understand exactly how this stacking or this participating benefit works, because there is some confusion out there. There's a few other companies that do it similarly and a few that do it differently. So just like if we had an income rider, folks, we have 2 separate values that we're calculating with this income choice product. We've got account value on one side, we have income value on another side. So on the income value side, this is the income value we're looking at on the screen. 100% of your premium goes into the income value, and you get a 5% bonus to the income value as well. That equals your beginning year income value. You do not get a bonus on the accumulation value, okay? It's just a 5% bonus on the income value. By the way, this is a flexible premium product. If you want to add additional premiums, you can. Any premiums you add for the first 5 policy years will receive the 5% bonus on the income value side. Now remember how I mentioned this product provides both a level of predictable but also potential maximum income. So where the predictable side comes in is here. The income value is guaranteed to roll up by a 2% compounding roll-up for up to 20 years. So no matter what happens in the interest, no matter what happens in your account value, we're still going to guarantee a 2% compounding roll-up for up to 20 years. So you can look a client in the face today, and you can say, Mrs. Client, based on your premium today, in 5 years, 8 years, 14 years, here's what your guaranteed lifetime income will be. Worst case scenario, North American's still going to credit a 2% compounding roll-up. That's where the predictable side comes in. Remember, and some of you are probably saying, well, God, Casey, you just talked about a 6.25% guaranteed roll-up. Why wouldn't I sell that? Again, this product is not designed for the client that needs the most guaranteed income, but we still do have a level of guarantee. Where the potential maximum income comes into play is on top of that 2% compounding roll-up, we will add 150% of the dollar amount of interest that is credited to the accumulation value each year for up to 20 years. So 2% compounding plus 150% of the dollar amount of interest that is credited to the accumulation value. That equals your year-ending income value. And I want to go through an example here to make sure we're clear on how that 150% of the dollar amount works. So beginning of the year, your income value on a $100,000 premium is $105,000. Remember, you get the 5% bonus. You get then at the end of the year a guaranteed 2% compounding roll-up, or in this case, $2,100. And let's assume that at the end of the year, whatever strategies you chose, there's a 2% interest credit to your accumulation value. 2% of $100,000 is $2,000. But with this participating, the stacking portion, we make that 150% of whatever that dollar amount is. So in this example, it's not $2,000, it's going to be $3,000 that we add on top for your ending year 1 income value. So again, it's 150% of the dollar amount that is credited to your accumulation value each year. And I think you'd agree, 2% in the example I just showed is a pretty conservative number, even in today's interest rate environment. As a matter of fact, on a deposit of $250,000 or more on the income choice, the fixed account right now is 2.05%. So that's a pretty conservative number. And we're going to take a look in just a minute at a true historical example using one of those uncapped strategies. But let me just again give you a quick screenshot of how that interest credit, that 150%, works. So in this example, based on this strategy, at the end of the first year, we've got a 12.92% interest credit to the account value. On your income value, remember we got the 2% compounding roll-up, and whatever dollar amount, that 12.92 added to the account value, we're multiplying that by 150%. So at the end of that first year, based on that calculation, your actual roll-up to your income value that first year in this historical illustration was 24.6%. Pretty nice. Are you going to get that every year? Absolutely not. As you can see if you look down. Again, year 2, a 1.92% interest credit. Remember, your income value grew by 2% guaranteed, and whatever dollar amount that 192 added, that converts to a 4.5% compounding roll-up. Oh, what about here? Here we had a 0, no interest credited this year, but guess what? You still get a 2% compounding roll-up because that's what the contract says you're going to get, and on and on and on. I just want to make sure that we were clear on how the stacking works, but when you look at an illustration, it's going to show you the effective compounding percentage roll-up. So let's do this. Let's take a look at a true historical illustration. And what we're going to look at here, and what I want you to consider is the power of this stacking roll-up, the power of that 150%. So here we have a 60-year-old client, $250,000. We're going to allocate 100% to one of those uncapped crediting strategies. It's an S&P 500 volatility control index. I know if you do any index annuity business, you know these things are really hot today. Is it the best thing for everybody? No, it's not. But for illustrative purposes, we're allocating 100% to that low volatility index with S&P 500, and right now that has a 1.5% margin, so a very competitive margin. We're going to let that grow for 10 years, and at age 70, we're going to start taking income on a single basis at a 5.65% payout percentage. Now the thing you're going to see on the screen next is a kind of a high-level summary of what our 13-page illustration would actually spit out. We use the NAIC model illustration regulation, so like a lot of companies, what we'll do is we'll look back on a 20-year period, and we'll show you the 10 best years of the last 20 years. We'll show you the 10 worst years of the last 20, the most recent 10 years, and of course on a guarantee basis, and how this thing would have looked assuming that allocation and that margin over that 10-year period. The numbers I want you to pay attention to, you'll see a lot of numbers on the screen. The numbers I want you to pay attention to more than anything are the interest rate numbers that you see there, because what they will reflect is the compounding roll-up on the client's income value over that 10-year period. Okay, and think about some of the other writers out there today and what their roll-ups are. Even our 6.25%. Just kind of keep that in mind. So here we go. This again is showing you the power of that stacking, that 150% stacking roll-up on that income value. So let's start in the worst case scenario. Worst case scenario, 10 years in a row the market is flat or down. Okay? This is client, your effective annual compounding roll-up in that scenario was 2.5% over that 10-year period, and your $250,000 premium you gave us is now $320,000 on the income value side. That's going to guarantee you a lifetime income of just over $18,000. Couple of things, and I always get this when I'm at a meeting too. Well, Casey, 2.5%. I'm selling a 6.5% guaranteed compounding roll-up. So why on earth would I talk about this? Again, keep in mind, folks. Number one, this is not designed for a client looking for the highest level of guaranteed income. Talk about the Income Pay Plus rider. Plus, Mr. Agent, I'm assuming you're paying probably at least 1% for that 6.5% compounding roll-up. So what's your client's account value in this scenario on that product that you're talking about? It's substantially less than $250 because we've been pulling 1% off a year, right? What's the account value here? In this example, they gave us $250. It's still $250. There's no charges or there's no fees coming off, okay? And Mr. Agent, if you had chosen that trail commission option we talked about, guess what? You'd have gotten $2,500 a year for the last 10 years, even in a worst case scenario. So yes, I understand there's better guaranteed riders out there. That's not what this thing's designed to do. Here's what it's designed to do. It's designed, again, just a reminder, here's your paycheck, Mrs. Client. If this $18,000 in a worst case scenario can cover your bills and those paychecks, awesome, because guess what? Here's your paycheck money. Look at this. When we look at those three different scenarios, lowest, most recent, and highest, look at the effective roll-ups on that income value over those 10-year periods. And look at your income, Mrs. Client. When we look at the highest, the best case scenario of the last 10, you've almost doubled your income from 18 to almost $36,000 potential income. That's the power of that participating, that stacking income. Can I guarantee you're going to get 9.66% a year, Mrs. Client? No, I definitely can't guarantee that. Can I guarantee 8.07? Absolutely not. Here's what I can guarantee, but more than likely what will happen is at the end of 10 years, your effective annual roll-up probably will fall somewhere in between the highest and the lowest on this historical illustration. That's the power of that 150% participating, stacking roll-up. Those are some nice numbers. Again, there's your play check, Mrs. Client. Look at all the fun you can have with that. If this is your bills and you're getting $30,000, you got a lot of play check money, Mrs. Client. So again, that was the one enhancement. Last thing here real quick, folks. I also talked about, we talked about this on the Income Pay Plus, we also added an increasing payout option on the Income Choice product. However, unlike the Income Pay Plus, there's no flat amount of increase. That increase each year is based on 100% of the interest that is credited to your accumulation value each year. So, Mrs. Client, let's assume that at age 60, your income value is $150,000, okay? At age 60 on a level payout option, your percentage payout is 4.65%. That's going to guarantee you, I'm just going to say $7,000 starting at age 60, guaranteed for the rest of your life. But, Mrs. Client, if you want to take a slightly lower payout, 3.65%, the 1% less to start with, starting at $5,500 each year, if your account value, like it does in this example, increases 3% every year, guess what, Mrs. Client? Your income is going to increase 3% each year. Or, Mrs. Client, if next year your account value, because of whatever strategies you've chosen, goes up 6%, guess what? Your income is going to go up 6%. If the market's flat or negative and there's a zero interest credit, your income doesn't change. It's going to stay right where it was effective last year. But in this example, this just shows an exact 3% increase a year on that client's income. So you can see when they start taking income, yeah, you're going to start out less. You're going to start 27% actually less at age 60. And you can see it doesn't take real long at just a 3% interest credit each year for that increasing income option to catch up. 7-8 years is when that break-even point is there. And guess what, Mrs. Klein, if you live to, let's just say, close to life expectancy, age 85, now your increasing income payout option is paying you $11,674 a year. That's 164% more than had you chosen that level payout option. Again, the question is, which is better, Casey? Which should I choose? It really, based on your client's health, is the only question the only answer I can really give. If you've got longevity and you plan on living a long time, you know what? I don't see any reason why you would not choose the increasing payout option. Let your income keep pace with inflation and keep the purchasing power that you need to buy those goods and services 5, 10, 30 years from now. Here's just another quick screenshot for you showing a client that starts taking an increasing payout option at the 6th contract year. You can see 1.59% interest credit to their account value that next year. That income is going to go up 1.59%. Next year, the interest account or the account value goes up 367. Your income goes up 367. 10% the next year, income goes up 10%. So on and so forth. So again, a nice opportunity to provide that client, make sure that their income keeps pace with inflation, because I'm sure you get that question an awful lot as well. One other competitive advantage piece here, folks. Again, I showed you that other one that's kind of stacking us up against the competition. Well, I think the term stack here really applies. How do we stack up? How does the Income Choice 10 stack up against another participating income type product? Well, this is showing us and the S&P Volatility Control Index with a 1.5% margin versus one of the top 10 selling index annuities last year that has a Barclays U.S. Dynamic Balance strategy. And when you look at us over, again, those different scenarios, 50 to 75, deferring for 1 to 15 years and then taking income on a level payout option, in the most recent 10-year scenario, folks, we win 100% of the time. Are we going to win 100% of the time in every scenario? No. Again, absolutely not. And again, this is where I encourage you number one, to give us an opportunity, first of all, and make sure you utilize the expertise at Insurance Network America. They can help you figure out what's best in each situation. So the last thing I get, the question I always get then after doing this presentation is, well, Casey, which is better? Is the Income Pay Plus a better rider for my client, or is the Income Choice 10 better for my client? Well, I think there's three things you really need to consider for the client based on their situation. Number one is, again, if they need an absolute high guaranteed income, if that paycheck they have is very high and you need a higher roll-up on your income value, you're going to want to talk about the Income Pay Plus rider with the 6.25% compounding roll-up. If they have longer than 10 years to defer, I would encourage you're going to want to take a look at the Income Choice 10, because again, that deferral, that stacking 2% plus 150 will go for up to 20 years. And then the last one, and this is kind of a little, probably a more important one too, is the client's risk tolerance. Are they willing to sacrifice some of the guarantees for the potential that Income Choice 10 can provide? Because again, I think you saw some nice potential income with the Income Choice 10 product. And again, folks, no one size fits all, no one rider, no one product is better in every situation for every one of your clients. Just know that we've got options for you that you can tailor to your own clients' and prospects' needs. And again, all I ask is give us an opportunity, right? Utilize Insurance Network America for their expertise. They know these things inside and out. I have trouble keeping track of my own products. I don't know how they keep track of 15, 18 different companies, but they do it. Utilize their expertise, but give North American a chance. That's all I can ask. We never ask for 100% of anybody's business whatsoever, because we know we're not the best in every situation. And with that, Tom, we've got about 5 minutes left. I covered a little longer than I expected, but I think it was valuable information. And if there's any questions that you want me to answer now, great. If not, I'm sure your folks will follow up with the agents as well.
Absolutely, and thank you so much, Casey. I think we're coming up on the top of the hour, but I want to provide you guys with a couple of closing thoughts. Here's a couple of questions in mind to ask your clients. What steps have you taken to cover basic income expenses during retirement? Do you know how much income you'll need in retirement? How much will that be? And lastly, have you prepared for, or have you taken the necessary steps to create uncorrelated returns for when market volatility or inflation hits during retirement? So a couple questions to take with you. If you have clients in mind right now and you think this would be a great solution, please don't wait. Call us today. We'll help you put a proposal together. We're here to make this simple for you and help you to focus on where you need to be, which is in front of your clients and growing your business. Our sales team at INA will be following up within the next day to make sure you have these competitive sales tools that Casey referenced on the call. If you need them sooner, again, don't wait. Give us a call. Hopefully everyone has our 800 number. Again, it's 800-456-7999. If you're not contracted with us yet, you need to be. Again, we have the right solutions, we have the right contracts, and the right people to help you. And what makes us so different at INA, and I hear this all the time, and we forget it sometimes, we put your clients and your practice first. Amazing, isn't it? Again, I want to thank everyone for participating today and stepping away from your practice. We know that's hard to do. We know that's hard to step away from what you do. So I want to thank you for joining us and taking a little time out to hear what we had to say here. Hopefully these are all helpful things to your business. I want to thank our partner, special guest Casey Lane with North American. Casey, thank you again. And once again, our number is 800-456-7999. Everyone, have a terrific day. If we didn't get to address your questions, we will certainly address those when we reach out to you within the next day. So thank you very much.